4, okay. 3, I'm actually happy with because of what I've read. It could be something to consider in terms of this and that. Okay, if there's a conflict meaning they don't see eye to eye, basically. Here they said when GAAP applies to a specific country. Okay, so you do get SA GAAP. Okay, that was what it was referred to previously before it was harmonized with IFRS. Okay, you do get US GAAP as well. Okay, that's what the Americans use. The Americans use a slightly different system. Check your textbook and see, maybe, because if they're using the more recent textbook, they might be referencing something specific in your actual textbook. Yeah, see, in mine, they talk about GARP here, but this is in relation to South Africa. When you're looking for something that confirms it, 100% confirms it. Okay, because I mean, I can even Google it. I'll show you. Let me show you this. Let's bring up Google here. You can type in US GAAP. Okay, there. IFRS versus US GAAP. What is the difference? Right, Americans use their own system of accounting, USA General Accepted Accounting Practice. IFRS is just the international set of rules that over 120 odd countries use around the world. Okay, so South Africa has their own GAAP, SA GAAP. Here. Okay, so SA statements and interpretations of statements of generally accepted accounting practice, SICA. Okay, is SA GAAP still applicable? Okay, obviously South African GAAP is in line with IFRS now. All right, so back in the past, South Africa chose to go international and to follow an international rule-setting body, basically. Let's search for another one. Let's search for UKGAAP, UK GAAP. Here, see, the UK Generally Accepted Accounting Practice. Okay, all countries have their own Generally Accepted Accounting Practice. Right, I'm happy with 1. Right, that's why I'm not going with 1. 1 is correct.
So it's between 2 and 3.
Yes. Okay, so between 2 and 3, initially I was going with 3, but obviously if you look at the textbook explains that. So for me, this seems a little bit strange. The wording here seems a bit odd. Ultimate financial reporting standard for state-owned entities like Eskom. To me, because Eskom is a state-owned entity, they have to follow the Public Finance Act. I think they call it the PF something A. I'll show you what it looks like. PFSA, something like that. Public reporting. Let's try that again. Public Financial Management Act. There's it. The PFMA. Here we go. Okay. I know because certain public institutions that have qualified audits, they have qualified audits because they aren't in line with the Public Financial Management Act. Okay, this PFMA. Right, so when you're looking at public companies like Eskom needs to follow this. Let's write down Eskom. Will it come up? Here, legislation. See, there. Furthermore, the statutory duties, responsibilities, and liabilities imposed on the directors of Eskom by the Companies Act, as amended, are augmented by those contained in the Public Financial Management Act as of 1999. Okay, what is the Public Financial Management Act? The Act is to regulate the financial management of the public sector within the rules and laws of the country. Okay, so when they say, this is a giveaway, when I see the word ultimate, to me, ultimate means it's the be-all and end-all. Does that make sense?
Yes.
Okay, so I like question 3, and I can confirm it with the textbook. Page number, 6. Let me just go back. Yeah, page 6, page 7 actually. In my textbook, it's on page 7 where they talk about instances where there is a conflict. Okay, in other words, a difference. Okay, between the framework and the standard. Okay, the standard would always take preference because the standard is more specific, right? So I like 3 because it's in line with the textbook. Okay, my only reason for going with 2 is because when they say ultimate meaning we have to follow that, but you also have to follow the what is it? The PFMA. Okay, what I googled here. Where is it? Here. That's my only reason for going with 2, because public institutions like ESCOM, SAA, Transnet, all of them. Okay, all of those public financial institutions don't only have to follow IFRS, they also have to adhere to the Public Financial Management Act. So that's my reasoning for going with 2 as being false. It's not the ultimate. Ultimate meaning it's the be all and end all. Okay, so I would say option 2 is incorrect because public institutions like ESCOM and SAA, etc., must also adhere to the requirements of the PFMA, the Public Financial or the Public Finance Management Acts, right? And that's my
I found it in the textbook.
Pardon?
Anthony, I found it in the textbook. It's actually in my textbook. It's on page 9.
What? This PFMA?
Yes.
Good. Okay, there you go. All right, so your textbook's actually better then. If they're bringing in that, that's better, yeah. So
because it's the current regulatory South African financial reporting requirements.
Yes, there we go. See? All right, now you've got it. So your textbook has it. Mine's a bit outdated, so obviously they're not talking about the PFMA, but that's an addition. Okay, that's something additional that South African companies have to adhere to. Yeah, so that's why I'm going with it. If you can confirm it, that's even better. So page 9, new textbook. Perfect. Well done. All right, happy with that one?
Yes.
Great. Okay, so number 2, the 2 most important fundamental qualitative characteristics which financial information must have to make it useful are the following. Okay, this is looking at qualitative characteristics, something that they've outlined again in your textbook. Okay, relevance, definitely. Okay, obviously materiality, not really. Detail representation, no. Faithful representation, yes. Okay, it's either between 3 and 4. Which one are you going with? To me, faithful representation would be more important than reliability, but they're both equally important. Which one are you going with?
3.
You're going with 3, okay. Let's just double check. Here, qualitative characteristics. To make information useful, it must be relevant and faithfully representative. Represents what's purports in the financial statements. Yes, I agree. Okay, that's confirmed by the textbook as well. Okay, good. Okay, option 3. Question 3. Which one of the following is classified as an adjustment? Recording the payment of an accrued expense, recording the depreciation for the year, recording the credit losses recovered, writing off additional credit loss. Easy question. Which one are you going with? An adjustment means a year-end adjustment.
Yes, I got 1.
Ooh, no, option 2.
Really? Why depreciation?
Depreciation is an adjustment.
But so is an accrued expense. We did that under adjustments.
No, when you provide for an accrued expense, not when you pay for the accrued expense. If I'm paying an accrued expense, that means I have a transaction that's recorded when it happens. So you can have accrued water and light, and then you pay for it.
So then could you not be writing off additional credit loss? That would be an adjustment.
Writing off an additional credit loss occurs when you write off the credit loss. An adjustment only occurs at year end. Depreciation is provided for at year end because depreciation is disclosure. It's updating the assets to reflect the actual worth at a particular moment in time. A depreciation is not a transaction. Okay, depreciation is an adjustment. Okay, these are transactions.
Okay.
If I record a payment of an accrued expense, that's a transaction. If I record a credit loss recover, that's a transaction. If I write off a credit loss, that's a transaction. The moment it takes place, I record it. The depreciation is provided for.
Okay, I get it.
Okay, let's just see here. Okay, in your textbook, they don't group it into categories. In some textbooks, they have a chapter just called adjustments, and then they even put depreciation in there. Okay, I've looked at other textbooks at other institutions, and I've seen it done differently. So some textbooks label a chapter adjustments, and then they cover all of them. Then they cover accrued expenses, prepaid, etc., and you'll even find depreciation in the chapter. Here, it's part of disclosure, so you'd have to look for it somewhere in chapter 2, potentially. Is it in your textbook? Have you found it somewhere?
I'm just checking.
Okay, your textbook might have a bit more content. I want to see if I can find you something here. Okay, depreciation, let's see. No, not covered here. Debentures. I'm looking at the contents page, the index. Yep, not in here. So you're going to have to refer to the previous version of the textbook. Do I still have that copy? Let me go check. No, I'm going to have to scrummage through lots of textbooks in the bookshelf. Okay. Yeah, it's definitely 2. Okay, and it's 2 because depreciation is a year-end adjustment. You're updating it, yeah. Okay, I know it's correct. It has to be correct. Okay, you can probably find something in your textbook. If not, you can look at other books. Let me see if I can. Let me show you something. Just give me a second here. Let me just go back to my. Let me see if I can put up something else that can show you. Let me just see here if I've got another textbook reference. Okay, here. Okay, in this textbook. Okay, this is a Juta textbook. Let me see if I can find a chapter here. Let's see. There, year-end adjustments, chapter 14. Here. Okay, so this is additional supporting information for a different textbook. Okay, obviously not yours, but it's an 8th edition version of this textbook. It's the most recent edition. There, chapter 14, year-end adjustments. And if you look at this chapter, you will see there the common ones, accrued, prepaid, etc. Okay, and then you will also see where's depreciation? Did they cover it here? Maybe here. Okay, not quite, but kind of. All right, here they talk about year-end procedure. Let's see. Okay, these notes don't really help us much, but they're referring to the textbook. See, various adjustments. Okay, page 370 to 379. Let me grab the textbook. Okay, in this textbook, on page 370, let's see, where is it? Here, page 370 to 379. Okay, they're saying look at these other transactions. Okay, I'm paging through. All right, I can see obviously prepaid, accrued, income received advance. Okay, then I have errors here. Okay, and then I've got year-end adjustments, okay, and then here, in the year-end adjustments, the illustrative example, okay, you can see here, depreciation, additional information. Depreciation on plant and equipment is calculated 15% per annum. And then if you look at their requirements, they say prepare the journal entries for the year-end adjustments, and depreciation is even provided for as a journal entry. It's definitely option 2, 130%. Okay, did you find something in your textbook?
No.
Still not. Okay, it's probably
No.
because this came out of last year's or last semester's content. Okay, depreciation would have been covered in FAC1601 02. Let me see if I still have a just to maybe give you more peace of mind. Here, learning material. Let me just go look at my 1502 stuff. Let me just open up a study guide. Here's a study guide. Okay, what study guide is this? This is 20. I think this is the new one. It says 2020 on my save file. Yeah, I think someone else, this was something that here we go. Okay, here's topic A. So this is something you would have done last term. Here, study unit 6, adjustments, page 98. Okay, let's go to page 98. There, adjustments. Okay, here in adjustments, you've got prepaid, accrued, consumables, income received advance. Okay, they didn't give depreciation here, but it does go, it falls under this as well. Okay, here they've gone with bad debt, but bad debt is an not an adjustment, it's a transaction that you write off. Let's see if I can find more here. Let's show you. Here, prepaid, accrued. Okay, here they're looking at adjustments, consumable stores, accounting journal entries. Here's accounting entries, credit losses. Okay, here they said refer to that paragraph in the book. Okay, credit losses is a write-off of bad debt as and when it occurs. So when a debtor is insolvent, you write them off. Okay, that write-off will occur when you realize they can't pay. Okay, it's not a year-end adjustment. It's just a normal adjustment. It's something that you would provide for as and when it takes place. Okay, here we go. Long-term adjustments. There's depreciation, 6.3. Okay, this is provided for only at the end of every year. At the end of each year, you have to provide for depreciation. This is a year-end adjustment. This is definitely what we're looking at. Okay, here's the journal entries. Right, this is a year-end adjustment. What did the question ask for? Which one of the following is classified as an adjustment? Recording the payment of an accrued expense? No. Recording the depreciation for the year. Because there's for the year, I would say yes. This is correct. More correct than any of the others. Recording credit losses? No. Okay, credit losses recovered as and when that takes place, you record it. If I write off additional credit loss, when it takes place, I write them off. Okay, that's just a normal transaction that you write off. Okay, number 2 for me is correct. Do you agree?
Okay. Yes.
Okay, yeah, so this is a year-end adjustment. It's something that you have to provide for only at the end of each year. This is not something you're going to be doing month on month. Okay, it only gets done at the end of the year to update your records, to disclose your assets accurately. That's why you do it. Okay, is that all right?
Yes.
Okay, number 4. A subsistence allowance paid to a partner is recorded by. Okay, so subsistence refers to like domestic. In other words, for their own purposes, for their home, for their residential benefit, basically. Okay, for their own benefit, for their private benefits. Okay, so
Is that like a
subsistence,
housing allowance?
yeah, it could be seen as something like that. Okay, but this a subsistence would be more like um, um, your living expenses. So they might be paying for your water and light, or they might be paying for your fuel and expenses, that type of thing. Subsistence is
Okay.
more like living expenses, if that makes sense.
Okay.
Okay, let me give you the definition. Subsistence. Subsistence. Ooh, spelling. Here, subsistence. Subsistence, the action or fact of maintaining or supporting oneself. Okay, so when you talk about subsistence allowance for a partner, it would be those basic necessities: food, water, electricity, etc., that type of thing. Not really a housing allowance. Well, yes, in a way, but not quite. Okay, subsistence would be more something they're consuming. So they're consuming the food, they're consuming the electricity, etc. Okay, it's upkeep, it's maintenance, it's ongoing. Okay, so okay, that's what you've got. Okay, so they're paying a subsistence allowance to the partner. Okay, we've spoken about partnership disclosure. Okay, number one, debit the subsistence bracket salaries account and disclosing the transaction as accrued expense. Do you show this as part of salaries and wages?
No.
No. Debiting the subsistence account, um, debiting the subsistence to partner's account and crediting the partner's current account. So their current account is going up because you're crediting it. Will their current account go up?
No.
Think about it. It's an allowance.
It is an allowance, but is this not coming out from the what do you call it? This is coming out from the business, right?
Yes. Okay, but
So
how
the
do you show
business
that for the partner's
allowance.
benefit? What account shows the partner's benefit?
Okay, the partner's current
The
account.
partner's current account, exactly. Yes. Okay, so this one's looking right. Okay, number three, debiting the statement of profit and loss. No, you never ever show partner specific transactions in the income statement. That's wrong. Number four, debit the drawings account of the partner and crediting the bank. Okay, was this cash?
No.
No. Okay, it's an allowance provided to the partner. Does that make sense?
Yes.
Okay.
So two.
Yes.